Welcome to the Deep Dive. We've been looking at Ooma Inc's latest earnings, that's OMO on the ticker, and we're ready to unpack their Q2 fiscal year 2026 call.
Yeah, and it's more than just the numbers this time. There seems to be this interesting strategic shift happening.
Right, something that could really change how the market sees them.
Yeah.
But first, let's just cover the highlights, the results snapshot.
Yeah.
Because honestly, UMO really delivered this quarter.
They absolutely did. Beat analysts' expectations pretty much across the board. Non-GAAP EPS, revenue. It signals some, pretty strong operational efficiency.
Yeah, they didn't just meet targets. They actually reported record non-GAAP net income and adjusted EBITDA.
Which is impressive. It feels like more than just small gains, right? It suggests they're really getting better at turning revenue into actual profit.
Exactly. And the market noticed shares ticked up a bit, though maybe a little measured.
Maybe, yeah. Perhaps investors are still figuring out the whole story. But let's dive into those financials a bit deeper.
Okay, so for Q2 fiscal 26, non-GAAP EPS was $0.23. That beat the consensus by 3 cents. Solid beat.
Mm-hmm. And revenue.
Came in at $66.4 million. Also beat by about $700,000.
Yeah.
It's roughly 3 to 3.5% growth year over year. Respectable.
And what's really interesting, I think, is where that revenue came from. 92% of it, so $61.1 million, was from subscription and services.
That's huge. It really underlines that recurring revenue model. Very stable, very predictable.
Absolutely, which investors love, right? And you mentioned the non-GAAP net income record, $6.5 million. That's up 59% year over year.
59%. That's leverage right there, not just growth.
Definitely. And the adjusted EBITDA, also a record, $7.2 million, hit an 11% margin.
Which puts them right at the low end of their own midterm target range, that 11-14%. So they're hitting their mark.
Shows they're turning that revenue into profit effectively. And their AER, the annualized exit recurring revenue.
Right, the run rate for subscriptions.
Stood at about $240 million, up 3% year over year. But here's a metric I found really compelling. Net dollar subscription retention hit 100%.
Wow, 100%. Up from 99% the quarter before.
Exactly. That means existing customers aren't just staying, they're actually spending more on average. Upgrades, add-ons, that sort of thing. Huge signal of customer satisfaction and value.
Yeah, especially after they finish dealing with that big customer churn event from the previous quarter. So stabilization plus growth from the existing base.
Mm-hmm. And the cash flow looks healthy too. Trailing 12 months, operating cash flow around $26 million, free cash flow about $20 million.
Gives them flexibility. So, okay, strong financials, good profitability story. But is this just good execution or is it proof of that strategic shift we mentioned?
That's the million-dollar question, isn't it? Which brings us to the strategy and the innovation side. That's really the engine here.
Okay, let's break it down. First up, AirDial. That's their POTS replacement solution.
Right, replacing those old copper landlines. Big market.
Huge, and often mandatory for businesses needing reliable lines for alarms, elevators,
Yeah.
AirDial momentum looks really impressive. Bookings more than doubled year over year.
And they landed a big one. A national retailer planning a rollout to over 3,000 locations. That's a massive win.
Supported by T-Mobile, too, their partner.
Yeah, that validates the whole offering, doesn't it? Shows it can scale. And it's not just that one win. The partner network is growing nearly 35 resellers now.
Including 3 new ones just in Q2. And apparently 2 of those used to sell competitor stuff.
That's a great sign. Plus, they're seeing early orders from Comcast, and another key partner is really starting to ramp up installations.
What about the revenue per line on AirDial?
The estimate is a blended ARPU around $25 per line per month. And they're working on enhancing the management portal and cutting hardware costs too. So growth and margin focus.
Makes sense. Okay, so AirDial is tackling legacy tech. What about their core SMB UCaaS offering, Ooma Office?
Also looking stronger. Metrics improved across the board, user growth, ARPU, and importantly, the take rate for higher tiers.
Right, I saw that. 61% of new Office users chose the Pro or Pro Plus tiers. That's up from 58% last year.
And overall, 37% of all their Office users are now on those premium tiers. It shows the upsell strategy is working, and customers see value in the advanced features.
Which is great for stickiness and ARPU.
Definitely.
Yeah.
And they're adding more value, too. They're launching Connect 5000 in Q3.
The new 5G internet solution.
Exactly. Bundled with Wi-Fi, prioritizes voice. It's basically a double play offer internet and phone from UMO. Deepens the customer relationship, makes them stickier, adds revenue.
Smart bundling. And they're leaning into AI as well.
Yeah, developing AI-driven features specifically for SMBs. They're leveraging their internal AI work to create stuff that's powerful but also easy to use and, crucially, low cost.
Could be a big differentiator for smaller businesses that can't afford custom AI. Plus, it enhances their contact center offering.
Right. And then there's the wholesale side, the 2600 hertz platform.
What's new there?
Launched new mobile and desktop apps in Q2, added video meetings, team chat, signed a new customer, expanded with existing ones.
Okay.
The key strategy here seems to be bringing Ooma's own IP onto that platform. This strengthens the turnkey applications for smaller customers using 2600 hertz.
While still keeping the flexible API-based side for the big custom deployments.
Exactly. Management's calling it the platform of the future compared to older tech. It's a smart dual approach, trying to capture both ends of the market.
Got it. And quickly, the residential side?
Had a better quarter for attracting new customers. Churn was a bit lower. Subscription revenue was up slightly from Q1, but still down 2% year over year.
But they're still adding ISP partners.
Yes, 7 new ones signed in Q2. So it's not the main growth engine, clearly, but they're keeping it stable.
Okay. So with all this going on, how are they using their cash? Capital allocation?
Well, they definitely see their stock as undervalued. They bought back $4.5 million worth of shares in Q2.
And that makes it $14.5 million over the last 4 quarters.
Right. It signals management's confidence, but they're also looking at M&A.
Acquisitions, okay.
Tuck-in opportunities is how they put it. Smaller deals, easy to integrate. They're focused on buying users, strategic customer bases, rather than buying tech.
So acquire customers and move them onto Ooma's platforms.
Seems to be the plan. It's a balanced approach, buybacks for current value, small M&A for strategic growth.
Makes sense. So what's the outlook then? What did they guide for Q3 and the full year?
Okay, for Q3 FY2026, revenue expected between $67.2 million and $67.9 million. Non-GAAP EPS projected at $1.22 Clown to 723 cents. Pretty steady.
And the full year, fiscal 26.
Revenue guidance is unchanged, $267 million to $270 million.
Okay, so steady top line, but the profit story.
That's where the change is. They raised the full year non-GAAP net income guidance, now $24.5 million to $25.0 million.
And EPS.
Also raised, now 0 times and $87.89 for the full year.
So better profitability than they initially expected. Why?
Mostly R&D efficiency. They expect R&D spend to be flat or maybe even slightly lower in the second half. Plus, careful sales and marketing spending, keeping it around 27% of revenue. And a small tax benefit helped too.
Got it. And adjusted EBITDA guidance raised too.
Yep, now projected between $28.5 million and $29.0 million for the full year. It really reinforces that theme of operational discipline and increasing profitability.
And they expect business subscription revenue to grow 5-6% for the year, while residential slips maybe 1-2%. Clear focus there.
Absolutely. So wrapping up the context here, this quarter really shows UMO executing well, balancing that, modest top-line growth with really accelerating profitability.
Yeah, the market reaction was positive, but maybe didn't fully capture the underlying momentum. Could just be small cap liquidity dynamics, though.
Could be. But the AirDial story, especially that big retail win, really highlights their potential in the POTS replacement market. That's a huge ongoing shift.
And the overall market is favorable, right? Hosted voice, UCaaS, projected to hit $32 billion by 2028. That's a nice tailwind.
Definitely. Key things to watch now are that AirDial rollout, adding more partners, and seeing the 2600 hertz platform mature with those turnkey solutions, probably next year.
Management seems focused on driving growth and profit to build value, maybe pushing EBITDA even higher next fiscal year.
That seems to be the long-term vision.
Okay.
So let's put on our committee hats for a sec.
Right. This is not financial advice segment. Let's hear the audacious but plausible trade idea.
Okay. Think about AirDial's bookings doubling year over year, that massive retailer win. That's building a really sticky, significant revenue stream.
And 2600 hertz, the platform of the future, getting fully built out by year end, already landing enterprise clients like Service Titan.
So the idea, go long UMO, maybe with a 2-year view, not just because they raised profit guidance, but because of the potential for a valuation re-rating.
Explain that. How does the re-rating happen?
Well, right now, the market maybe still sees Ooma partly like an old school telecom, right? Lower multiples.
Yeah, often happens.
But as AirDial really scales, replacing thousands, maybe millions of POTS lines eventually, and as 2600 hertz proves itself as a true platform as a service, the whole narrative could shift.
Towards more of a SaaS or PaaS valuation, higher multiples.
Exactly. The bet isn't just on them growing profits by a few percent here or there. It's on the market fundamentally reevaluating what kind of company UMO is becoming.
So if AirDial keeps accelerating, or if they land more big 2600 hertz deals faster than expected,
The stock could see a significant upward re-rating, moving away from that small cap telecom box towards multiples you see in, say, higher growth communication platform companies. It's about changing perception based on execution.
interesting. It's definitely a play on the strategic shift paying off and the market catching up.
Plausible, right, given the trends we just discussed. So that wraps up our look at UMO Inc's Q2 FY2026 earnings.
Yeah, it's clear they're juggling multiple pieces, SMB UCaaS, POTS replacement, wholesale, but doing it with strong profitability and a clear eye on the future.
Definitely executing on that strategy. As always, remember, this is just our take for informational purposes. It's not financial advice.
Please do your own research. What stood out to you from the call? How do you see UMO's path forward? We'd love to hear your thoughts. Thanks for tuning in to the Deep Dive.